So today I'm going to help a whole lot of you save a ton of money and avoid a costly mistake. Today's video is going to be about, is whole life insurance worth it or not? So whole life insurance is frequently pitched as an investment alternative to brokerage or rental real estate or a bunch of other things. And the question is it useful and worth it as an investment vehicle? We're going to go through a real life example of a question a prospect asked me about a whole life insurance policy that was pitched to them. We're going to explain how whole life insurance policies work and when they should actually be considered as investments. Spoiler alert, in general, they are not good or comparable as an investment compared to the alternatives available. Welcome. If you're new here, welcome to the channel. My name is Eric Amzalag. I am the owner and head financial planner at Peak Financial Planning. We're a fiduciary fee-only financial planning practice that works with clients all over the country to help make sure that your money outlives you by recommending good financial decisions and helping you avoid bad financial decisions, as we'll explore in this video about whole life insurance policies. So stay tuned. We're going to jump right into it. To begin this evaluation, we need to set up a framework here. So whole life insurance is one type of life insurance, but we really need to split this evaluation into two categories. The first is, how does whole life insurance compare to other types of life insurance for life insurance purposes? Life insurance is all about the death benefit or the amount of money that someone or beneficiaries would get were the owner of the policy to pass away. And this is basically an effort of creating financial stability or security for beneficiaries or dependents in the case that someone they relied upon were to pass. So how does whole life insurance compare to other life insurance types? The second way we need to evaluate whole life insurance is by discussing how it compares to other investment types of a similar nature. So it's not a given that whole life insurance is an investment. We have to think about it first. How does it compare as a life insurance tool? And then second, how does it compare as an investment tool? And that's what we're about to do. So with that framework in mind, let's start by addressing how life insurance works and how whole life specifically stacks up against the alternatives that are available. So life insurance can be split into two categories. There's what's called temporary life insurance and permanent life insurance. The distinction is about the length of time which you are covered and given and guaranteed that death benefit. So temporary life insurance, also known as term life insurance, covers you for a predetermined amount of time that has an expiration date. Once that expiration date is hit, in order to continue the coverage, you will either need to go back through the underwriting and evaluative process to determine if you're fit or insurable for life insurance, or you'll need to purchase a rider or some kind of a fee-based extension on the contract in order to extend your life insurance. For example, if you were to purchase a 20-year term life insurance policy, you would be insured for 20 years. So in 2023, if I purchased it in 2043, that policy would expire. If I died anytime between now and 2043, my beneficiary, let's say my wife in this case, would receive the insurance amount. Let's just make up a random number, $100,000. If I died between now and 2043, my wife would receive that $100,000 as a result of the death benefit of this temporary life insurance policy. If I lived until 2044 and then died in 2044 and the policy expired, my wife would get nothing. That's how term insurance works. Whole life insurance is a type of permanent life insurance. How that works is, as long as you pay the premiums over time, you remain covered for that life insurance death benefit until the policy either lapses or until you pass away. So that means you can, if you get covered at age 25, you could potentially remain covered under the same policy with the same premium for the rest of your life. So that's how they function. Now, whole life insurance also has a death benefit feature, just like term life insurance. So if I were to pass and I owned a whole life insurance policy, my beneficiary would get the death benefit. And then the second thing whole life insurance has that term life insurance does not have is something called cash value accumulation. So cash value accumulation is usually pitched as the investment portion of whole life policy, because when you put money and pay in premiums to that whole life insurance policy, over time, there's what's called a forced savings feature, which functions like a savings account attached to this whole life policy, where as you pay in premiums, a certain amount of those premiums, either through dividends or interest, are returned to you and accumulate in this forced savings pool. So that's how the two policies work. Now, at a life insurance level, how does whole life compare to term life or other life insurance types? Well, whole life insurance is more expensive. There's more fees, but the benefit is that it carries on permanently through the rest of your life. When we move to this discussion to talk about how it compares as an investment, that's where we'll start to understand the distinction better of, well, should you just purchase term life insurance at a cheaper rate and then invest the difference you would have paid in the cost between term life insurance and whole life? Or should you do whole life insurance, and when should you do that? So now we understand how the life insurance portion of the policies work. Well, how does the investment portion of the policy work? And how does it compare to other investments? So I'm going to explain it a little bit, and then I'm going to show you a model based on a question that a prospect asked me about a whole life policy that was pitched to them. So at its root, the forced savings feature, or that cash value accumulation feature, is pitched as the investment portion of the life insurance. Typically, cash value will grow at a rate between 1 and 3.5% per year, depending on the policy. How much cash value accumulates in the policy depends on the policy you purchase, the cost of the insurance. So that means how much death benefit are you purchasing and how much of the cost goes to insuring that death benefit. And then the remainder goes in as cash value over time. And the question is the amount of cash value that stacks up and the rate of return you get on that worth the trade-offs you give up were you to put that money somewhere else? So what are some of the trade-offs here? Well, when you put money into a cash value life insurance policy, if you want to take that cash value out over time, it reduces the death benefit. The other thing is, if you were to stop paying premiums into that whole life policy and let the premiums come out of the cash value, which is possible. Let's say you paid in and you eventually had $50,000 of cash value in a policy, and then you could stop paying premiums and actually allow the premiums to come out of the cash value so it doesn't come out of your own income. Well, if you were to, at that point, take money out of the cash value, you have to be very cautious that you don't cause the policy to lapse by taking out too much cash value and not leaving enough in there for the premiums. But how does this compare to other investments? A 1 to 3.5% rate of return is not impressive. You could get a conservative rate of return on a conservative brokerage portfolio of 5 to 6%. And the question is, how does that stack up against them? So I'm going to share some numbers with you about an actual example policy so we can evaluate an apples to apples investment comparison. So in this case, the prospect was pitched a policy where they would pay $250 per month in premiums into this policy in exchange for an $175,000 death benefit. $250 a month is $3,000 a year in premiums. When we looked at the actual cash value accumulation projection that was given to the prospect, I noticed that after 2 years of paying in $250 a month in premiums, they would only have $950 in cash value. So at the end of the 24th month, they would have $950 of cash value, which means they paid $6,000 in premiums and really only had $950 saved. So the rest of that premium amount had all gone towards cost of insurance, the cost of purchasing the policy, and other kind of black holes. We don't really know where that money went. So at its face, they put $6,000 in. They really only have $950 saved to show for it. Not very impressive. In this example, they would continue to put $250 per year for 10 years. And at the end of the 10 years, they'd stop paying the $250 premium. So the question is, how much would they have in cash value at the end of those 10 years? And on their policy, they would have around $27,000 accumulated at the end of the 10th year. At the end of that 10th year, it's important to note they would have paid in $30,000 of premiums or $30,000 of cost so far to have a $27,000 cash value accumulation. So the question is, if they had invested that money into a brokerage account or some simple, vanilla, not sexy alternative that functions similarly, what would they have at the end of 10 years of investing $250? And the answer is they would have somewhere around $41,000 after 10 years if they had invested $250 a month into a regular brokerage account at a 6% rate of return. So nothing sexy. 6% is less than the average rate of return on the S&P 500. So just on an apples to apples comparison there, if they had just invested that money, they'd be $14,000 better off investing it. In this example, this prospect had been pitched that they would, at the 10th year, stop paying that premium and just let the money grow for the next 20 years. At the end of the 30th year, they'd have a certain amount of cash value that would accumulate in the policy that they could then tap into and use for things about their life. They could use that cash value like a savings account. At the end of the 30th year of that whole life insurance policy, they would have $46,000. So that $27,000 from year 10 grew into $46,000 after another 20 years of sitting in that policy. What if you had done the same thing with the brokerage account? So if you remember, if we had invested that $250 for 10 years into the brokerage account, you would have $41,000 in the 10th year. Let's say you stopped putting $250 a month into that and just let that $41,000 grow for the next 20 years at the same 6% rate of return. What would you have? The answer is, at the end of that 30th year in your brokerage account, you would have around $135,000, assuming that 6% rate of return. So you would have 295% roughly more money in that brokerage account than you would have in accumulated cash value in that life insurance policy. So clearly, the life insurance policy is not comparable as an investment option. And that's kind of the case I would make to this prospect. This policy is pitched as an investment, but all it is an investment for the salesperson of the policy. the actual customer, the prospect I was speaking to, ends up paying all this money in premiums. They lock up that money somewhere and it gets a subpar rate of return for many, many years. The only way to access it back out, they'd have to pay taxes on it. They'd have all these issues and they'd have to let the policy lapse or go back to paying premiums because they would wipe the cash value out of the policy. With this brokerage account, they retain access to the funds. They get a much better rate of return. They have better tax consequences too, because brokerage accounts face long-term capital gains tax rates rather than income tax rates. And so they'd have more favorable tax consequences, very likely. So all around, the whole life insurance policy, I'm not convinced. I'm a fee-only fiduciary financial advisor. I don't get commissions for selling anything. And you couldn't convince me that this life insurance policy was actually suitable as an investment. Could you convince me that it might be a good idea as a life insurance? Maybe, because the idea of permanent $250 premiums could be a good idea if you're maybe have bad health or you age poorly and the cost of insurance in the future might be really high. But that's not what we're evaluating here. We're trying to decide, how does this compare as an investment and is it worth it? And my answer in this case is no. You would be much better off taking that money, putting it into a brokerage account, investing it conservatively, and retaining access to those funds, having flexibility and the ability to use those funds over time, along with the more favorable tax consequences, rather than putting it into whole life insurance as an investment. All right, so if you stuck through that whole thing with me, clearly you can see that my summary is that whole life insurance, not great as an investment. Now, there are other cases where whole life insurance is useful. I'm not going to get into those in this video because it's more technical and it would turn this from a 10-minute video into a 25-minute video. I'll make a future video on what cases should investment life insurance be used and for what type of demographic, how much income you have, how much wealth you have, who is suitable for that type of life insurance based on my opinion. So I hope you enjoyed this video. I hope that by watching it, you'll save yourself from some costly mistakes where you might be pitched life insurance as an investment and unwittingly or unknowingly put money into it and end up in a subpar investment. Or if you are currently in a whole life insurance policy that was pitched to you and you thought it was investment grade and you don't really know how to evaluate it, I highly recommend you think about it through the lens of this video. You're more than welcome to reach out to me and my team and we'll help evaluate it for you. But I do appreciate your time and attention on this video. If you're looking for more videos like this on the topic of financial independence or retirement or this type of general subject, you can find a whole bunch more on my YouTube channel at Peak Financial Planning. If you did like this video, please like it on YouTube, subscribe to it. Let us know what you liked in the comments and share this with someone who's in a similar position to you who could benefit from watching this type of video. Thank you again for your time and attention. If you'd like to also reach out to our team, you can schedule a free consultation with our team using the link in the description to this video below, or visit our website, thepeakfp.com. And I'll see you in the next video.